This is the seasonal tendency chart for E-mini S&P. And I'm going to take you back in time. And I talked about how I like seeing the seasonal tendency that comes in the month of May, leading into June. June typically makes a really strong low. And that's just about every single year. Okay, that one's really, really strong. But I like having a shorting opportunity going into the last week of April, going into May, and then majority of May, we see some measure of selling. Well, this year, while we were anticipating it, the market internals did not present that idea in technicals. We were seeing the market show us that it's not likely that the seasonal tendency was coming into fruition this year. So this little movement right in here, okay, that's what I was looking at. That is a really easy breadwinner for the springtime, and it was not there technically. But I want to take your attention into how the third week of May and the third week of June, okay, see how we have June, July, May, April. This is approximately the third week of May and the third week of June. See that? This right here tends to be one of the best times to be a buyer of index futures for E-mini S&P. So if you're looking for a really strong mid-year point to buy, if you are in a bull market that you feel that is going to continue, because we didn't see a seasonal tendency come to fruition here, if they don't come to fruition, that's telling you something that's extremely fundamental to the next drive higher or lower. If it's not moving in tandem with what you would expect in terms of the seasonal tendency, that means it's doing something opposite. So if we were anticipating what? Lower prices for ES, and it's not willing to do this, that means we're extremely bullish. So we traded up into this gap or real liquidity void between this week's low and this week's high. Between this red line and that red line, I want to know what the midpoint of that is. That's what's being shown here. Taking us over to the current present week, you can see how we traded right up into that consequent encroachment here. Went above it just by a little bit, but look how beautiful the reaction was from here back down in, and we closed on the highs. Not at the highs. We just fell short of going into the 20% retracement for TGIF. All right, so let's go into a daily chart here. You can see the fair value gap. We mentioned that at the time. 2 down closed candles, that's your bullish order block. Extend that to the right. We had a start of the week. We traded down into the order block and then ripped higher, taking out buy side, digging into the low of the weekly volume imbalance, the consequent encroachment of the entire shaded area, which is the weekly volume imbalance, and then those 2 red levels up here, and then its respective consequent encroachment or midpoint of that gap that's being shown within the weekly volume imbalance. Just a really beautiful delivery for ES this week. Let's drop into a lower time frame here for the hourly chart on ES. You see how we dropped down into the order block, rallied through. Bullish order block, this is down close here, and we have a fair value gap that makes this a proper bullish order block because we're in context of a buy program. We're looking for higher prices. Everything should match there, and we're seeing a return back in to imbalance, order block, sell side taken below relative equal lows, and then starts to trade higher. Another order block here, trades higher, an aggressive run through the short-term high here. That's institutional order flow entry drill. And then rallies again, trades up into that weekly volume imbalance. Look at the bodies respecting the weekly volume imbalance. Yes, we have these little mohawks. That's inherent price action. It's normal to see that. It's perfectly normal and acceptable. Market rallies, trades up into the consequent encroachment of that actual liquidity void in the upper portion of that shaded pink area, which is a weekly volume imbalance. Here's a 5-minute chart. You can see again with the ES trading up into that consequent encroachment of the actual liquidity void at the higher portion of that weekly volume imbalance. And right in here, you can see a small little SIBI, which is a fair value gap, sell side imbalance, buy side inefficiency. That means the market will likely pull back up into that. It does essentially the consequent encroachment. We can see those measurements here, trades to it here, and then we want to see a sharp displacement lower. Do we get it? Yes. Did it take out a short-term low? Yes. What is this? That's the 2022 model I taught you on this YouTube channel. Fair value gap, trades up into it here, boom, that's a short. What do you aim for? The low under here delivers. And we have a small little fair value gap there, offering the 2 o'clock silver bullet. The market breaks lower, relative equal lows, we pull back up, retraces, and then aggressively runs lower off of hitting a breaker. High, low, higher high, this candle's your breaker, trades to it here, sells off going into the 3 o'clock hour. Small little fair value gap there as well. So we have high, low, sell side, hammers it in the final hour of trading on Friday. All right, here's NASDAQ. This is our weekly chart on NAS. So you can see the weekly fair value gap there. We traded down into that 2 weeks ago. And this is this present week. So we opened, traded down, aggressively moved higher, made a high, and then come off the highs. I want to zoom in on that. So we're zoomed in on the weekly chart, and I'm taking the Fibonacci and measuring from the low of the week to the high of the week. And I'm showing you the respective 20% and 30%, which is TGIF. So whenever you have a nice big run higher or lower, those are the times you want to look for TGIF. They're really likely to have these pullbacks towards the end of the week. And how far will it pull back? 20 to 30% of the weekly range entirely. That level's being noted here. Okay, so it's a way for you to remember that that model is a day of week specific model, and it's capitalizing on trading a reversal of the entire weekly range to a 20 to 30% level of the entire weekly range. All right, so let's go into the hourly chart. I want you to take a look at the low here, the high, and the lower low. And the market trades through this high. Okay, there's buy side above that, and we're looking for higher prices beyond that. But what can we use this information for in terms of finding range? Well, if you look at the teaching I gave you on advanced ICT breakers, when we see the stop run here that takes out the sell side below here, my eye goes right to the low, to the high, prior to the lower low that qualifies this as a bullish ICT breaker. So this is your measuring range. Extended here, negative standard deviation 2. It's not the actual high, but look how close it gets you. That's projecting a weekly range high. Okay, so this breaker, we expect it to trade through it. It does. We come back down into it. The bodies are respecting the breaker. The logic is this. Short-term entries, those that are in the pursuit of trying to go long, they were right prematurely until they were stopped out. So this perfect trap here sets the stage for those individuals that got stopped out trying to get long. They're too afraid to get back in, especially when this one more wipeout that takes out this low, which also took out that low. So we see a 1, 2, 3 drives pattern. If you see a level or a direction fail after 3 attempts and it breaks down, if you see a breaker or a model 2022 inside of that, oh, wow. What a beautiful model. I probably said too much, but anyway, the longs that have a sell stop below here, they get stopped out. They're not going to get back in. They're scared. They're not going to get back in there. But now the market will revert back to the individuals that are short here. Someone's short, so they're going to run on them. So the sell stops are being accumulated by smart money going long. They're buying those sell stops with the purpose of offsetting. So offset distribution is being used above this high. That's selling above a level for profit taking and waiting for confirmation that it wants to go higher. It does. So the market resumes going higher. Pay no attention to this level yet because it has to make a high of the week first. So when we had this big capitulation, this run up into a standard deviation of -2, then we have these relative equal lows, and the market draws down into that in the latter portion of the day, but back down more specifically into the weekly TGIF 20%. So after we see this level hit, we want to see, does it really want to break down from that? And then when we look at the lower time frames, we actually will see that actually occurring. So here's the 15-minute time frame. Here's the consolidation in the beginning of the day. And we had a report come out, sends price higher. Then we have this gap right there. So this returned back into this SIBI, which is a sell side imbalance, buy side inefficiency. Market trades into it here. We wick past it. That's completely permissible. Breaks down again. We have another gap. So this is institutional order flow entry drill where it just trades one little bit above this candle here. This happens on all time frames. But the context is you have to know where the market's likely to go. And because we have this gap here, and then we have this gap here in close proximity, that's what makes this an institutional order flow entry drill. Otherwise, if this wasn't here, I would expect it to trade more into this inefficiency. So the market does in fact trade below here, completely runs over top of this buy side imbalance, sell side inefficiency. Okay, does it here. And we have another gap there. We trade up into this and then rips right through sell side here and sell side there. And 20% of the weekly range is here. So all of these things match in terms of a draw on liquidity. There's a reason to anticipate it happening. The market's been going straight up all week, and then now we're at the end of the week. So this is completely acceptable and reasonable to see in price delivery. Okay, here's a 5-minute chart, and I'll show you the inversion fair value gap. That's why the market went up to that level here and went beyond the previous 15-minute. Right here, see this gap here? This gap, we're looking through that to the left. This right here is a buy side balance, sell side efficiency. The market trades down through it. This is a small little inerrant price action. It's a mohawk. It's a little nickname I gave it. That's completely normal. The market shows a willingness to respect the inversion fair value gap and then breaks lower, institutional order flow entry drill. And then we have this wick, okay, which doesn't do much in terms of damage below this low for sell side. So once we move through it, I liked this gap, but I wanted to refer back to this wick. So does this market respect that wick's consequent encroachment? It's perfect, isn't it? Look at these candles here. The bodies tell you the story. The wicks, they do the damage. And this is telling you narrative. It means the algorithm is in a sell program. It's going to seek sell side liquidity. It's going to run on sell stops. It's going to run to inefficiencies. Well, there's a small little inefficiency remaining here. It gets down to it there, comes back up into a small gap there, and then does what? Dives for the sell side and gets below the weekly TGIF 20% of the weekly range. I went short on here, trading inside of the idea that we were in this inversion fair value gap there. I took a little bit of heat on it, but not much, and then aggressively ran for the sell side, and there you go. Notice where we closed. Look at this. Real close to the 20%. So I'm going to leave that with you and remind you that these things aren't cherry-picked. These things are not coincidence. They happen every single week. And sometimes there are certain parameters that are met that allow for explosive runs. What took place? What took place this week? Think about it. What's occurring on the daily chart? Fair value gap. Boom. Third week of what? June. Just like that seasonal tendency calls for. Folks, those things are like roadmaps. And we knew in May, when the seasonal tendency that I like to see, where if it sells off, if I can find something technical that aligns with the market to see it go lower, if it's not providing that, that means we are really bullish. From this turning point right there, and then rips again in July. This move right here, this is a classic in the summer months. That part is, that's a classic scenario. If you're in a bull market, this is what you expect in the months of June and May. If we're in a bearish market, a sell-off in May into June, they're very, very good. That's how you use seasonal tendencies. The idea or premise behind a seasonal tendency that is failing, that is many times, not always, but many times, it is conducive for an explosive price run in the opposite direction to what you would expect in the seasonal tendency. So it's because we had the potential sell-off in May, didn't form. It did not form at that time. So that gives more rocket fuel for the June low that forms, and that's classic in stock index futures.